Hello, here to talk to you about your taxes and how they affect you with real estate. Of course, first I got to do a disclaimer. I'm not a tax accountant. I'm not a tax lawyer. I'm just a real estate broker sharing with you what I've learned about the taxes. So always do check with a tax professional. All right, now that the legal disclaimer is over, the awesome thing is the taxes you're working on right now in spring of 2018, your taxes don't change. What you're doing right now is what you've done as long as you've been filing taxes for most of us. So we're going to talk about how taxes affect you going forward and maybe how to plan and change what you do a little bit. The good thing is if you're selling your home or selling an investment properties, the provisions stay the same. There's still the $250,000 for an individual or $500,000 exemption of your taxes for capital gains when you sell a personal residence or a residence that you've lived in 2 out of the last 5 years. So that's kind of the caption. Every 5 years you can deduct $500,000 as a married couple or $250,000 as an individual on capital gains. If you're an investor and you're selling a property and wanting to roll that to a different property, what's called a 1031 exchange, that law was also untouched in the new tax code. The big thing that's changing is what your deductions are for mortgage interest. For the majority of my clients out there, again, nothing will change on what you can deduct because they capped the mortgage amount that you can deduct up to $750,000 for all mortgages going forward after December 15, 2017 is I think the cutoff. What it does do is it eliminates the interest deductions for home equities. So you can't get a home equity line of credit, buy a boat, and then be able to deduct that interest anymore. Or go on vacation on your home equity line of credit and then deduct the interest. That no longer works. So your purchase mortgage, whether it's a first and second or just all one into one first, that's still deductible up to a combined mortgage amount of $750,000. What changes is our standard deductions as families have largely increased. So it used to be an individual could only deduct, depending how you were filing, $4,000 to $6,000 approximately. Again, I'm not your tax accountant, but now an individual's able to deduct up to $12,000, and a married couple up to $24,000, just as a standard deduction. So to make that relevant to your mortgage, you would need a mortgage of over $267,000 as an individual to be able to deduct your interest and make it worth more than the standard deductible, or $533,000 as a married couple. Or some combination. You can do a combination of your mortgage. You still can deduct some state and local taxes, charitable contributions, or other contributions. So if you weren't filing an itemized deduction before, this doesn't really affect you at all. You're not going to file an itemized deduction now. For some people in 2018 for your tax year, you might find it's not worth filing a more complicated itemized deduction because your standard deductions have gone up. Again, do your own research on the internet or through one of the tax software, talk to a tax attorney or a tax accountant. But just want to give you the update as related to real estate. And Kerry Minden, CJM Realty.